In this presentation, I am going to describe one option strategy in Tata Motors. So if you are observing our YouTube channel, you will be getting that from the past couple of days, we are going on giving some option strategies. One day before, we have given for Infosys, and yesterday we have given for Reliance. Today I am going for the Tata Motors. And you have been seeing that Tata Motors is being in a rally from the couple of days. And how we can capitalize on that. So we have also scheduled one free webinar. If you are going to our YouTube channel, here we have given one free webinar link. You can just click here and register in that free webinar. So that free webinar will be the free webinar. This particular free webinar, if you just go to that video, we have given the link to register. You can register for that. This is on the coming Saturday and Sunday we have scheduled, and you'll be getting Saturday in English, 7th Sunday will be in Hindi, 1 hour, and we'll be explaining option strategy best suitable during quarterly result season. So this is the quarterly result season is starting, and we are giving couple of option strategies. So the main objective of option strategy formation is that always we have to work in a risk reward model. If I am taking a 1 rupee risk, I must have one probability to win 2 rupees or 3 rupees. So that is the first risk reward. And each time I deploy my capital should be protected to the extent of 95 to 97%. That should be the criteria of forming these option strategies. So I'm just going to describe one more strategy today on the Tata Motors. So it has now, today also it is 1.38% up, and it is trading at 205 rupees and 70 paisa. Yesterday it has given a breakout above 200. And what the trend suggests, if I'm going for one standard deviation and going for a 5 days move, then what the trend suggests, that is very important for me. So trend, we need to check the trend. So you can follow any method of your choice. So we are following our one standard deviation software. So this is a very good software to identify the intraday as well as the weekly trends. So here I am going for Tata Motors, and I am going for a positional options. I have to load the data first. So future, I have just taken the futures. I have just taken number of days as 5 days, or I can take 7 days also. 1 week period we can take it. So reference 206.75 it has taken now. It is suggesting and giving us a great picture here. It is suggesting that above 219 it can, or 211 above it can go till 219 to 222. If this level crossover happens, then you can go till 239. Same way, if it fall below 202, it has all probability to touch 191 level. And if it breaks that, it has all probability to come to 174 level. So I am going with a risk neutral approach, delta neutral approach, Vega neutral approach, theta neutral approach. Slightly it will look you complex, but this is a very simple strategy having a combination of market neutral strategy. Either it goes up, come down. So you'll 2/1 ratio call spread and 2/1 ratio put spread. This combination is there, and along with that, one more lot I am adding one out of money call option sell, one out of money call option sell. To this 2/1 call options and 2/1 put options, this spreads, net debit spreads what I am forming, I have chosen the strikes in such a way that 211 above my uptrend starts, just now I have seen, and I am seeing that 202 below my downtrend starts, 202 below my downtrend starts. So for that, what I am telling here, I am taking 210 call option, one lot I am selling at 9 rupee 85 paisa. Maybe that variation will be there. The time this video is being made and the time you are initiating, the variations will be there. And I am buying 215 call option 2 lots. So I am spending here 15 rupees 50 paisa by buying the 2 lots of call option. and I am getting 9 rupees 85 paisa by selling one lot of call option. Then I am going for the put options. As I have told you, 202 below my downtrend starts. So I am selling one 205 put option and buying two lots of 200 put option. So here I am just spending 12 rupees and 30 paisa. I am investing on the buying of option, and 8 rupees and 20 paisa I am getting it back. So by this process, if I can say that I have received near to 10, and here I invested 50, so 5 rupees 65 paisa net investment works out to so near to 10,000 or 11,000 rupees I have invested in this call side, and here too also, so 4 rupees 10 paisa, 8,000 rupees I have invested. So total 19,000 rupees of money I have invested. To reduce this 19,000, I'm just selling one lot of 230 call option, which is bringing me back another near to 7,000 rupees it is giving me. So here I am getting net investment in the capital front is only 12,000. Then the margin requirements will be there. So margin requirement I will be seeing there. So by this forming this particular strategy, what is the profit and loss? That is very important. So if I am just forming this particular strategy and I'm number of holding days is 5 trading days I am holding, it is suggesting me a great risk reward. So if Tata Steel goes to 236 level, I am at a zero loss, no profit, no loss. Beyond that, I am making a small profit. If it is going to 223, 225, that level what we have seen here, we are having one small loss, 2,400, 2,500. But no point of time my loss is increasing beyond 3,600. However, if it falls, I am making money the moment it is coming to 200 level, and that profitability is going on increasing. If it is coming to 191 level, I am making 7,000 profit. If it is coming to 181 level, I am making 19,000 profit. However, my loss is being capped. So why this loss is being capped with a maximum 3,600 and why the profit is expanding? So that is because of our market neutral strategy and because of its delta, vega and theta. So if you just look into the delta, vega and theta parameter here, your delta is minus 10% and vega is also 1.86. Vega you have to multiply with 10, you can get 1.86, and vega is stable. Instead of in the uptrend also 1.8, 1.5, 1.3, 1.1. So it is stable, and vega becoming 0 when we are just entering to the profit in the upside. Same way in the downside also, vega is stable. So 1.8 goes to 2%, 2.1. So once we are coming to the profitable zone, that time vega becoming 0, almost 0. So you can say 2, 2.0, 1.5. So 181 level we are at a maximum profit. Vega is at 1.48. And theta also is very stable. Theta is the time value. So in a day, 26 paisa of time value is going to be get reduced from all options, all strike options. So negative means 26 paisa reduction will happen all options. Selling side options will lose 26, buying side option also will lose 26 paisa. So you have buying side 4 lots, so 26 into 4, almost 1 rupee 4 paisa you will be losing, and you also have 3 lots of selling side, so 1 rupee 6 paisa you will be 1 rupee 4 paisa you will be losing, and same time on 75 paisa you will be getting back. So that is what the theta suggests you. And vega, each 1% fall in the volatility, how much of impact you will get in the premium, that gives. So here the theme of this strategy, when you are making the profit in the downside, your vega is stable, doesn't move wildly to a great extent. When you are making losses also, here your vega is almost stable, and once in the upside you have started making the profit, there also vega is stable. So here the theme is the vega is stable, theta is stable, and delta we can ignore, because at a time we can just neutralize 2 Greeks. So 2 Greeks we have neutralized, vega and theta, because there is a 2 days of constant up move was there. So first day it is a 6% uptake, then it is a 8% uptake, then we are moving today also 1%. So there is a 3 days of continuous up move is there. So let us see whether it is maintaining the same momentum or there is a trend correction happening on. If trend correction happens, we are making a great profit. So 1:2 risk reward is there. If there is a correction happens till 191 level also, we are making 7,000 profit. However, if this same uptrend continues for a couple more days, then we are also not making much losses, rather we are making a small loss or no loss. So this is a particular strategy we are taking with the anticipation that there is a great move happens. Now there will be a consolidation or there will be a small correction. To take the benefit from this, we are taking. But one more alternative I can show. Suppose that a 230 call option, if you are not selling, you are just buying 2 call, selling 1 call, buying 2 put, selling 1 put. That time also your deltas will be remaining same. But if you think about the Vega terms, Vega and Theta terms, you say Vega has increased, Theta is increased. So time value, decay components is going to affect you hardly or badly. Same way the volatility fall or rise also is going to affect you badly. So this is also a part we have mentioned here. So though profitability is great, once it goes to 226 above, you are making profit. Once it's falling below 191, you are making a profit. However, the liability part also is there because of the Vega and Theta. So this is I will recommend you must go with the strategy of selling also the call options. So here this particular strategy, so this also we give in our paid groups. So this particular strategy is mentioned here. 230 call option you are selling 1 lot. I just summarize. 215 call option you are buying 2 lots. This is buy and this is sell. And also you are selling a 210 call option 1 lot. So this also you are selling 1 lot. So call side is open. Now for the put side, your different objective you are following. So you are selling 205 put option 1 lot sell, and here you are buying 200 put option 2 lots you are buying. So by this process your total capital investment will be 2 lakhs 17,000 margin. On top of that you require 12,000 rupees fund also. So you can say your total investment in this strategy is 2 lakhs 29,000, 2 lakhs 29,000, and in this you have a maximum risk of 3.6 to 2.3600 to level of 0 you can say. So or slight profitability. I am telling that it is suppose 2 to 3,000 rupees loss risk and you have a probability to win 7,000 plus. So 1:2 risk reward or more than that it translates. Even though if you are not initiating this particular strategy, please do a paper trade. Please do a paper trade in this strategy. Just note down how this strategy perform a period of 5 days. So from today, if you are initiating 5 trading days, you go on counting one day by one. Day 1, day 2, day 3, day 4, day 5. And conclusion day, you just give me a feedback how it has performed. And to learn these option strategies in this result month, we have designed a fantastic program. Our 1 month program wherein you get the access to our Smart IT all-in-one tool. You get the access to 2 days of live session will be there to make you understand how our system works. 2 days of conceptual discussion, how to form an option strategy, pair trade and other things. And 15 days we will be giving you intraday trade analysis on index and crude oil in a training WhatsApp group, and post that option strategies with exit alert you will be given in a training group. Like the earlier training group is going on, we are putting the strategy like the earlier strategy we have given book profit in the Maruti strategy around 4,000. Similar way we will be guiding you to form the option strategy. Also we are giving them the proper months, like we have given yesterday the proper months. Whatever the strategies we have given in that training group, how far they have succeeded, that is very important. Very important. We have given the Maruti, yesterday it was 2,800 profit. These are the strategies we have given. So how far they have performed, That analysis also we are giving in that group. So do join this particular program. To join, visit our website, click on the seminar link and pay and register. It costs you only 590 rupees. And once you participate in that program, so you'll be given this kind of one WhatsApp group access and we'll train you for a month to work on option strategy. So keep following this strategy and give your feedback. Thank you very much.